So today we will discuss about the interview questions for the discounted cash flow. It's a valuation method. So let's start this. So the first one is very common question with the interview. It's a walk me through a DCF. So what is a DCF? It's a discounted cash flow method. As suggested by the name, it's a discounted like cash flow. Just uh, just go on the words like first one is discounted and second one is the cash flow. So cash flow, which one is discounted? Like the future pack cash flow, which one is discounted? So something like that. A DCF value a company based on the present value of its cash flow. Like you have the cash flow, like you are standing at the 2022 and you have to forecast for the 27, but in that case there's a future value. 27 is a future value, so you need to find out the present value of today. Like what is the value of the 100 rupees after the 27 on the 2027? So what is the value on today itself? Like if the 100 rupees on the 2027, so what is the value of the today of that 100 rupees? So this is something like that. So let's start with this. Like the DCF value of a company is based on the present value of its cash flow and the present value of the terminal value. Like it's based on the present value of cash flow and the present value of terminal value. Terminal value is something like the firm's value, like firm's value total value after the 27 or on the 27 on the forecasted period, something like that. So in that case, first you project out a company's financial using the assumptions for the revenue growth, expenses, and the working capital. Like first you project like this is the company's financial today, and this is the assumption for the revenue growth. Let's say 10% a year, and after that there's expenses, and after that is the working capital. So with the revenue also come the expenses, also come the working capital as well. And when you get down to the free cash flow for the year, so this is the free cash flow, like revenue minus expenses, and the working capital is also there, like average receivables, average payables, etc. So you get down to the free cash flow for the each year, which you then sum up and discount it on NPV. That's based on the discounted rate and usually the weighted average cost of capital. That is something like that. Once you have the present value of the cash flow, you determine the company's terminal value using the either multiple methods. Like when you have the present value of the cash flow, let's say I have the present value of the today's cash flow, and then I'll determine the firm's terminal value. It's a total value of the firm. After that, I'll use the two methods for this. First one is a multiple method, and another one is the golden growth model. And multiple method is something like that. Revenue multiples the 10 times of the 10 times of the firm value. Is the 1 times of the firm value. It's mainly depend on the similar companies, like to get on the apple to apple comparison. And apart from that, if you go for the golden growth method, so golden growth method is something like average or something like the average growth rate that couple on the year on year basis. Like today we have the growth of 5% and we forecast that the growth will be the 5% for the next year as well, for the next 5 year as well. So this is the golden growth method. So the growth is constant over the period, and then also discounted back to the net present value using the WACC. So we will also discounted this on the that also discount back to NPV using the WACC. So we have the WACC and we have the NPV. So we'll discount this on the basis of a number of factors. Then finally you add the together the company's enterprise value and the company's firm value, and then you get the this is my company's enterprise value today. So today it's a today's value. So let's do it on the Excel as well to get a better understanding on this. So next we'll go on to the another question. Is the walk me through the how you get the revenue to the free cash flow in the projections. Like how you get the revenue to the free cash flow in the projections. Like what is the revenue to the free cash flow in these projections. So we'll subtract the costs. Like first we have the revenue. Um like there's a journey from the revenue to free cash flow. So how we will separate this? So first we will go we'll go into the revenue. So revenue minus costs is a GP, and the operating expenses, then we get on the EBITDA without depreciation, or we can say that is the operating income, EBIT, if we subtract the depreciation as well. Then we multiply this by the 1 minus tax rate. It's a tax rate of the country. It's a depend on number of situations. Then we add back the depreciation again, and we add the another non-cash charges, and we subtract the capital expenditure and the change in the working capital. So this in this case we have the revenue from the free cash flow, or we have the subtract from the cash flow, so something like that. And if you get to the unlevered free cash flow and you want to of the EBITDA rather than EBIT, so you should confirm that this is what the interviewer is asking for. So this is one thing. So this is today. These are the today's questions. So we'll continue in the next session.